You think taxes get easier when you stop working? That's the illusion, because while you were employed, the system ran itself. Every paycheck, taxes withheld, sent straight to the IRS. No decisions, no pressure, no surprises. April came. You filed. Maybe got a refund. Maybe paid a little more, and moved on. But the moment you retire, that entire machine shuts off. No warning. No instruction manual. No letter from the IRS telling you what changes. No call from Social Security explaining your next move. Just silence. And suddenly, you're no longer inside an automatic system. You're responsible for every decision, every dollar, every mistake. I've seen retirees lose thousands in their first 2 years. Not because they were careless, but because no one told them what the IRS actually expects once the paychecks stop. Today, I'm going to show you exactly what changes. 10 things. Every single one of them matters. Most retirees miss this. Not some of it, almost all of it. And that's the dangerous part. Because none of this is obvious, and no one walks you through it when you leave the workforce. Before we go any further, understand this. This video is for education only. It's not tax advice. It's not financial advice. Your situation is unique, and you should always speak with a qualified tax professional before making any decisions. Now, let me introduce myself. My name is John Ag. I'm retired. And every single week I break down the tax rules, the financial traps, and the strategies that can protect retirees from the things no one else is explaining. If that sounds useful to you, subscribe right now. Turn on notifications, because what you don't know in retirement can cost you. Let's begin first. Set up estimated tax payments. If you don't, you will get penalized. When you were working, your employer handled everything. Taxes were withheld automatically: income tax, Social Security, Medicare. You didn't think about it. But in retirement, that system disappears. Now your income comes from everywhere: Social Security, pensions, IRA withdrawals, dividends. If that sounds useful to you, subscribe right now. Turn on notifications, because what you don't know in retirement can cost you. Now your income comes from everywhere: Social Security, pensions, IRA withdrawals, dividends, maybe rental income. And here's the problem. Most of these sources don't withhold enough tax. Social Security only withholds if you ask, and even then, it's often too little. IRA withdrawals might default to 10%, but your real tax rate could be 22% or higher. If you underpay during the year, the Internal Revenue Service charges penalties, calculated daily. In early 2026, rates were around 7%, then 6%. The fix is simple: quarterly estimated payments. Deadlines: April 15th, June 15th, September 15th, January 15th. There's also the safe harbor rule. Pay 100% of last year's tax, 110% if income exceeds $150,000, and you avoid penalties. Here's the reality. You owe $14,000. Only $8,000 was withheld. You're short $6,000, and no one told you to fix it. Here's where it gets expensive, fast. That's $6,000 you underpaid. The Internal Revenue Service spreads that across 4 quarters and applies penalty rates. By the time it's calculated, you're not just paying $6,000, you're adding another $300 to $400 in penalties. Now here's what most retirees never hear. There is relief. If you're 62 or older, retired within the last 2 years, and have a reasonable cause, the IRS may waive the penalty entirely, but it's not automatic. You have to file Form 2210 and check the waiver box. Miss that and you pay the penalty without even knowing you didn't have to. Second, Social Security can be taxed. If your income crosses $25,000 single or $32,000 married, up to 85% of your benefits may be taxable. You can fix this by filing Form W-4V with the Social Security Administration and choosing withholding 7%, 10%, 12%, or 22%. Third, understand provisional income. It's your adjusted income plus tax-free interest plus half your Social Security. Cross the thresholds, and suddenly your benefits are taxable based on limits set decades ago, never adjusted for inflation. Here's the part no one warns you about. Those fixed income thresholds? They now hit over half of Social Security recipients. And it's not just your tax bracket anymore. Every extra dollar you earn can push more of your Social Security into the taxable zone. That's how retirees quietly end up facing effective tax rates of 30%, even 50%. Not because rates changed, but because more of their benefits suddenly become taxable. If you understand this formula, you control the outcome. If you don't, you overpay. Fourth, there's a hidden advantage most retirees miss. A new law introduced a $6,000 bonus deduction for taxpayers age 65 and older. That's $12,000 for married couples. It stacks on top of your standard deduction. Income limits apply: $75,000 single, $150,000 joint. Then it phases out. It's available from 2025 to 2028. Filed on a new Form 1A. And here's the problem: not every tax software applies it automatically. If you missed it, you can amend within 3 years. Fifth, required minimum distributions. If you have a traditional IRA or 401k, the Internal Revenue Service requires withdrawals starting at age 73. Miss one, and the penalty isn't small. Here's where timing turns into money. Your RMD is calculated using your account balance on December 31st of the previous year, divided by an IRS life expectancy factor. You get one choice that matters more than most people realize. Take your first RMD in the year you turn 73, or delay it until April 1st of the following year. Sounds harmless, but it's not. Because if you delay, you don't skip a withdrawal, you stack them. Now you're taking 2 RMDs in 1 calendar year. That can push you into a higher tax bracket, make more of your Social Security taxable, and even trigger higher Medicare premiums. Miss an RMD altogether? The Internal Revenue Service can hit you with a 25% penalty, reduced to 10% if corrected quickly, but still painful. Example: $500,000 IRA, about $19,200 RMD. Delay it and suddenly you're pulling nearly $38,000 in 1 year. Now, there's a smarter move. If you're over 70 and a half, you can use a Qualified Charitable Distribution, QCD. Send up to $111,000 directly from your IRA to charity. It counts toward your RMD, but isn't taxed. Same donation. Different path, thousands saved. Seventh, this is where strategy begins: Roth conversions. These are the years that decide everything, the gap between retirement and age 73. Before RMDs begin. Before Social Security fully kicks in, is what I call the transition window. Your income is lower. Your tax rate is lower, and that makes it the perfect time for Roth conversions. You move money from a traditional IRA into a Roth. You pay tax now, but after that, growth is tax-free, withdrawals are tax-free, and there are no RMDs for life. And here's where it gets powerful. If markets are down, you're converting at a discount. Convert $50,000 today. Pay tax on that amount. If it rebounds 20%, it becomes $60,000. Inside the Roth, completely tax-free. Wait until recovery, and you're taxed on the full $60,000 instead. At a 22% rate, that's a $2,200 difference on one move. Do this consistently, and you're saving tens of thousands over time. The strategy? Fill your current tax bracket, don't spill into the next. And don't wait. Every year missed is a lost opportunity. Now watch this carefully. RMAA, the Medicare surcharge, no one explains. Cross certain income thresholds, and your premiums go up automatically. Here's the hidden cost no one prepares you for: IRMAA. Your Medicare premiums aren't based on today's income. They're based on your tax return from 2 years ago. In 2026, cross $106,000 single, or $212,000 married. And your premiums jump 70 second coiled. Or $20,000 married. And your premiums jump $70, $200, even $400 plus per month per person. One large IRA withdrawal, one Roth conversion, one capital gain. That's all it takes to trigger it. If it's a one-time event, you can fight it. File SSA 44 with the Social Security Administration. But you have to act. Ninth, update your address with the Internal Revenue Service. Miss a letter, you miss a deadline. And deadlines mean rights, appeals, negotiations, all gone. CP 14, you owe? CP 2000? Mismatch, LT11 or letter 1058, final warning action in 30 days. Open every letter, immediately. 10th, run the numbers every year. Standard deduction in 2026 is massive, especially with senior add-ons and the new $6,000 bonus. Many couples can shield over $47,000 from taxes, but with higher SALT limits, itemizing might win again. One choice can cost or save you thousands. And here's the real loss most people never see. If you've been defaulting to the standard deduction since 2017, you could have been leaving $2,000 a year on the table. Over 5 years, that's $10,000 gone. The jump in the SALT cap to $40,400 changes everything in 2026. If you live in a high-tax state and haven't recalculated, do it now. Let me simplify this. 10 steps. Set up estimated taxes. File W-Vort for VA. Calculate provisional income. Claim the $6,000 senior deduction. Know your RMD timing. Use QCDs, do Roth conversions. Watch RMAA. Update your address with the Internal Revenue Service. Recalculate deductions every year. 10 moves. The system expects you to know them. Most retirees don't, and every misstep costs money. If this helped, like the video, subscribe. Share it with someone retiring soon, because no one hands you this checklist on your last day of work.